Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Lucid.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine building this billion-dollar state-of-the-art factory, right?
Okay, yeah.
You've got the most advanced robotics on Earth in there. You've hired, like, top-tier aerospace engineers, and you secured the most expensive real estate possible for it.
Sounds like a dream setup, honestly.
Right, but there's a catch. You're only selling enough products to, like, barely keep the lights on in the front lobby.
Wow. Just the lobby.
Just the lobby.
Yeah.
And that is pretty much the exact reality for Lucid right now. Today, we're looking into their recent earnings, the chart data, analyst notes, basically trying to figure out if this company is just a falling knife.
Or, if they're actually setting up for this massive turnaround, because they did just slam the brakes on some pretty aggressive bankruptcy rumors recently.
Yeah, they did. And the market is completely divided on what happens next. It's a really highly charged environment right now.
It really is. But hey, before we start unpacking all these numbers, if you're out there trying to navigate these massive price swings and, you want a cleaner way to read the charts, there's a tool we want to mention called VIP Algos.
Yeah, the link for that is right below in the description. VIP Algos is this TradingView indicator suite. And it's actually really cool because it displays visual buy and sell alerts directly on your screen.
Right, which takes a lot of the guesswork out. It has trend direction tools. It automatically maps out your support and resistance zones. And it even gives you areas for take profit and stop loss planning.
Exactly. And it's super versatile, too. It works across stocks, Forex, crypto, gold, indices, all of that. But we do have to remind you, VIP Algos is strictly an educational chart analysis tool, right?
Yes, very important. It is not financial advice.
Yeah.
It doesn't place trades for you, and there are absolutely no guaranteed profits.
Right, because trading involves risk.
Yeah.
You always need to manage your own risk and do your own research. And just so you know, that link in the description is an affiliate link.
Which just means a commission might be earned if you use it, but it's at absolutely no extra cost to you.
Exactly. So, getting back into it, let's put Lucid into a wealth-building perspective. If someone's looking at this, they really can't treat it like a traditional portfolio anchor, can they?
Definitely not, no. You do not buy this looking for some sleepy, steady dividend yield to fund your retirement.
Yeah, you'd be in for a rough time. It requires a totally different mindset.
Completely. From a wealth-building standpoint, you really have to categorize this strictly as a turnaround play or, a highly speculative growth allocation.
Because the broader context here is the whole luxury EV market, right?
Yeah.
Which has just been slammed.
Slammed by macro headwinds, yeah. I mean, when interest rates are high, borrowing costs for an $80,000 car, they just skyrocket.
And demand naturally cools off.
Exactly. But the core opportunity here hinges on two things. First, we've already had this massive valuation reset. The air has basically been let out of the bubble.
Right.
And second, there's a major operational shift happening. They're scaling up their second vehicle platform, the Gravity SUV.
Which is huge for them. Getting a second model on the line isn't just about, having a new car to sell. It's literally the only way they can distribute those enormous fixed costs we talked about.
Across a much higher volume of units, exactly.
But I want to make sure we're grounded in reality here before we go further. This isn't a scenario where you buy the stock, forget about it for 5 years, and just hope for the best.
Oh, no. Absolutely not.
It takes a really risk-aware, disciplined investor. The volatility is extreme, and the downside risk is, frankly, total capital loss if they run out of money.
Yeah, if they can't manage that financial runway, it's game over.
So looking under the hood of the actual business, what do the fundamentals look like right now?
Well, they present this really fascinating contradiction. So start with their competitive moat, right? The underlying business quality is built on genuinely proprietary tech.
Like their powertrains, right?
Yeah, their powertrains and battery management systems are just engineering marvels. Because the motors are smaller and lighter, they're getting industry-leading range and charging speeds.
So from a pure efficiency standpoint, they actually have an edge against the legacy guys.
Oh, totally. Against Mercedes-Benz, even Tesla. Their product architecture is legitimately superior.
Okay, but, great engineering doesn't always equal a great business. Are people actually buying these cars?
They actually are. The top-line momentum is surging right now. If you look at their trailing 12-month revenue, the year-over-year growth is sitting at 61%.
Wow, 61%.
Yeah, and in Q2, vehicle deliveries were up 20% compared to last year. So that's a clear signal that demand is accelerating.
I'm guessing a lot of that is tied to the hype around the Gravity SUV.
Exactly. Anticipation and the initial ramp up for it.
Okay, so revenue is growing fast.
Yeah.
Sounds fantastic on paper.
Mm-hmm.
But here is the massive disconnect I'm seeing.
The bottom line.
The bottom line. If they're selling that many more cars, why is it bleeding out at such a catastrophic rate? Those profit margins are deeply, deeply negative.
Yeah, they are. And this really gets to the heart of automotive manufacturing economics. Their gross margin over the last 12 months is nearly negative 93%.
Negative 93%. That's rough.
Let's break down what that actually means mechanically. If they sell a vehicle for $100,000, it's costing them nearly $193,000 just to build it.
Ouch.
Yeah. Earnings per share is negative $10.55, and the overall net margin is sitting at almost negative 240%.
They are just funneling unbelievable amounts of cash into R&D and factory capacity. Right?
Unbelievable amounts, yeah.
Which brings us back to that factory analogy from the start. They've built the capacity to manufacture hundreds of thousands of cars. They're paying rent, utilities, salaries for this massive plant. But because they're only producing a fraction of what it can handle, every single car that rolls off the line has to carry the financial burden of basically an empty building.
Exactly. The operating leverage is there, it's just waiting to be utilized. But the scale isn't there yet.
And that dynamic kind of explains their current valuation floor, right?
It does. Because of this aggressive cash burn and the stock price collapsing, their price-to-book ratio has fallen below 1. It's currently around 0.88.
So for anyone unfamiliar, the price-to-book ratio compares the market value to the actual accounting value, right?
Yeah.
Like the factories, patents, cash in the bank.
Exactly. So when it drops below 1, the market is essentially saying that the business, as a living, breathing thing, is worth less than the sum of its raw parts if you just sold them off tomorrow.
That is wild. The engineering is top tier, but the financial structure is terrifying.
Terrifying is a good word for it.
So what actually changes this trajectory? Like, what are the near-term catalysts we're looking at?
Well, let's look at the macro environment first. Out in California, the governor recently unveiled a $3,500 EV rebate specifically for first-time buyers.
Okay.
That acts as a really tangible demand catalyst. It directly stimulates their total addressable market. Plus, we've got potential Fed rate cuts on the horizon.
Right. Auto financing has been brutal lately.
Exactly. So any reduction in interest rates makes financing a luxury vehicle significantly cheaper.
I do have to push back a little on the California rebate idea, though.
Okay, why is that?
We're talking about an ultra-luxury vehicle here. The starting price is astronomical. Does a $3,500 rebate really sway a buyer who's in a tax bracket to afford a $100,000 car?
I mean, on an individual level, for someone paying cash for the absolute top-tier trim, probably not.
Right.
But you have to think about what incentives do to the broader ecosystem, you know? It changes the psychology of it. It brings foot traffic back into showrooms.
That makes sense.
It shifts the narrative for the whole sector from stagnant demand to, like, incentivized growth. And don't forget, as they inevitably scale down market with more affordable trims, that $3,500 becomes a much bigger chunk of the purchase price.
Fair point. It changes the weather, even if it doesn't water the specific plant. What about internal catalysts, though? When's the next big test for the company?
The immediate hurdle is their earnings report in August 2026.
Market's going to be hyper-focused on that.
Oh, absolutely. They're going to ignore the grand vision and just focus on one thing, the Gravity SUV production ramp.
They need to see the math working out.
Exactly. Analysts need mathematical proof that as volume goes up, those devastating gross margins are finally starting to improve. Also, we need to watch the fallout from their recent C-suite reorganization.
Which was interesting. Why did they shuffle leadership at such a critical time?
Well, transitioning from a startup that builds these amazing prototypes to a true mass manufacturing powerhouse, it requires a totally different skill set.
Ah, right. Visionary engineers are great for designing it, but you need ruthless operational executives to optimize the factory floor.
Right. The supply chains, all of it. So the market will be watching August earnings to see if that new leadership is actually translating into efficiency.
So let's take all this fundamental data and look at the actual market reality, the chart. The price structure is just brutal right now.
It's bad.
It's trading around $4.65, which is barely above its 52-week low of $2.37. It's down nearly 80% over the last year.
Wow.
And over 46% just in the last few months. It's trapped in this relentless downtrend.
It's been thoroughly dismantled, for sure. But looking at the TradingView recently, there's a really interesting glimmer of stabilization.
Really?
Yeah, we saw a slight intraday bounce directly off those extreme lows.
Oh, okay.
And when a stock gets hammered relentlessly like that and buyers suddenly step in right at the absolute bottom, it often signals a capitulation point. We might be seeing a short-term base forming in that $2.37 to $4.65 zone.
But how do you know it's actual capitulation and not just, a random blip?
You look at the volume regime, the trading volume is running incredibly hot right now. The 10-day average volume is over 1.5 times higher than the 3-month average.
Okay, so mechanically, when you see a massive volume surge combined with a violent downward price move like that recent 21% drop over 5 days, you're looking at classic washout selling.
Exactly.
That's the moment retail investors basically throw their hands up in despair. Margin calls force brokers to sell, and algorithms just clear out the weak hands.
The selling pressure exhausts itself because everyone who is going to panic sell has already done it. And those shares transfer to institutional buyers waiting at the bottom.
Exactly, the mechanics of a bottoming process. But man, trying to catch a falling knife manually on a chart this volatile, it's incredibly difficult.
Oh, it's so hard.
Which, honestly, is exactly why having clear visual tools like what VIP Algos helps map out with support and resistance is so important. Trying to eyeball it while a stock is dropping 20% a week is just a recipe for emotional trading.
Definitely. You need objectivity. So the chart is showing us extreme fear and potential exhaustion. But what does the broader market sentiment look like? What are the pros saying?
Well, Wall Street is pretty understandably pessimistic. The mood is heavily bearish, mostly skewed by those earlier bankruptcy fears and weak deliveries across the whole auto sector.
They're playing it safe.
Very safe.
Oh.
Like RBC Capital recently maintained a sector perform rating, but they lowered their price target slightly from $8 down to $7.
Right, and let's translate that Wall Street speak. Sector perform basically means analysts are paralyzed.
Pretty much.
They're not confident enough to call it a buy, but they're terrified of a sudden turnaround, so they won't say sell. And lowering the target to $7 just means they expect it to stabilize here rather than totally collapsing to zero.
They are firmly sitting on the fence. But while the analysts are on the fence, the people actually running the company are doing something completely different. There's this massive bullish divergence happening under the surface.
This is honestly the most fascinating data point in this whole setup. Massive insider cluster buying.
Massive.
Over the last 90 days, insiders net bought over 337,000 shares. That's 12 separate buy transactions versus only 7 sells.
That gives them an insider sentiment score of over 80.
Over 80 out of 100, yeah.
Think about the mechanics there. Insider cluster buying means multiple executives. The people who see the daily factory output, who know exactly how many SUVs are rolling off the line, and who have direct access to the bank accounts.
Right.
They are logging into their personal brokerage accounts and buying their own stock near all-time lows. That level of coordinated buying indicates immense conviction. Management clearly thinks the market has mispriced their risk of failure.
And that conviction sets up a really explosive speculative scenario, because a lot of institutional money has bet heavily against them surviving. So short interest is elevated.
Highly elevated.
When you combine high short interest with aggressive insider buying, the stock becomes a prime short squeeze candidate.
Let's break down how a short squeeze works, just in case anyone's unfamiliar. When funds short a stock, they borrow shares and sell them, hoping to buy them back later for cheaper, right?
Exactly, to pocket the difference.
But if the company announces a surprise catalyst, say earnings reveal a huge improvement in gross margins, the stock price spikes. Those short sellers start losing money rapidly.
And to stop the bleeding, they're forced to buy shares at the current market price just to return the ones they borrowed.
Right, and that forced buying drives the price even higher, which triggers more short sellers to panic and buy. It's this violent, self-feeding, upward spiral.
It is. So that sentiment profile is a thrilling upside case, but we absolutely have to anchor this with the severe risks involved here.
Yeah, we can't ignore the elephant in the room. Solvency.
Solvency is the big one.
Despite recent capital infusions and lifelines, they still might need to secure additional funding just to survive through 2027.
Yeah, when your net margin is negative 240%, $1 billion in the bank disappears frighteningly fast.
Which leads straight into execution risk. Because they're losing so much money on every car right now, the rollout of the Gravity SUV has to be completely flawless.
Zero margin for error.
If one key supplier is late or there's a software bottleneck, the line halts. But the fixed costs, the rent, the machinery that keeps draining the bank account every single day.
It's terrifying operating leverage on the downside.
And I want to circle back to the price-to-book ratio being under 1. Traditional value investors often see that and think, oh, it's a safety net. The assets are worth more than the stock price.
Right, they think it's a bargain.
But in reality, a low price-to-book ratio does absolutely nothing to protect an equity investor if the company just runs out of cash and is forced into bankruptcy.
Because in liquidation, the debt holders get the factory, the patents, the cash.
Exactly. The stockholders almost always get wiped out to zero. That solvency risk, the fear that they'll go bankrupt or dilute the stock into oblivion to survive, that is exactly why the stock is down 80%.
So with all these moving parts on the table, what is the final assessment?
Well, based on all the data points, the bullish score comes in at a 4.
And the final stance is that this represents a quintessential high-risk, high-reward turnaround play.
Yes, and the target horizon for this specific setup is a swing trade heading into their next earnings report.
So to summarize the balancing act here, the upside is driven by that strong 61% revenue growth, the impending sale of the Gravity SUV to fix the margins, the heavy conviction from insider buying, and the real possibility of a short squeeze.
Conversely, the downside is defined by the desperate need for a longer cash runway through 2027, the punishing gross margins, and just the sheer operational danger of launching a new vehicle platform.
Definitely. And we do want to explicitly remind everyone listening, this breakdown is for educational purposes only.
Yeah, we're analyzing data and market mechanics, but this is never financial advice. You have to determine your own risk tolerance and do your own due diligence before putting capital into something this volatile.
Absolutely. And, before we wrap up today, if you want a visual aid to help make sense of the chaotic price action we talked about, definitely consider checking out VIP Algos through the link below in the description.
Yeah, it's a TradingView indicator suite designed to provide visual buy and sell alerts, map out support and resistance zones, and help with take profit and stop loss planning right on your charts.
But again, it is strictly an educational tool to help you analyze the market. It's not financial advice, it doesn't execute trades for you, and it cannot guarantee results.
Right. Trading always carries risk, so please manage your capital wisely and do your own research. And remember, that link in the description is an affiliate link, meaning a commission might be earned if you use it, but there's no extra cost to you.
And if this analysis helped you understand the mechanics of the market better today, please consider subscribing, liking, and leaving a comment underneath. We'll see you in the next Smart Wealth with Joshua Talk.
Until then, I want to leave you with one final thought to kind of mull over. We've spent this whole time analyzing their ability to survive as an independent company. But what if that isn't the real endgame here?
Oh, interesting.
Think about it. If their powertrain technology is truly superior to Tesla's and their valuation is this depressed, are we looking at a standalone turnaround story? Or are we watching management dress the company up to be the ultimate plug-and-play acquisition target for some massive legacy automaker that's desperately behind in the EV race? Just keep that possibility in mind as you watch the price action unfold.